Hello, guys. How are you? I hope you're doing great and everything is well with you. So, in this video, I will be doing the owner's equity, where I will be starting with the illustration of the statement of changes in equity. So, statement of changes in equity is still part of IFRS 18. It's still part of the financial statements. So, it's a very important part of this assessment opportunity because it's going to be asked. Does it make sense, guys? Possibility that it will be there are very much high. So on our statement of changes in equity, we always have to have the columns and the rows. Does it make sense, guys? So on the first one, we will have share capital. So for share capital, it's either you have what? You have ordinary share capital or class A capital share capital. It's ordinary share capital, or you have preference share capital. So that's what you will have. Doesn't make sense. So you don't mix ordinary share capital with preference share capital and you call it share capital. You don't do that. If you have class A share capital, you will have a column for class A share capital. If you have class B share capital, you will have a column for class B share capital. Or if you have ordinary share capital, they will state that this is ordinary share capital and they will state that this is preference share capital. The second one, guys, you have after your share capital, make sure your share capital should always be something that you start with. You don't start with anything other than the share capital, because we have to provide a capital, then retain and reserve. Doesn't make sense, guys? So share capital, it's very much important for you to show it first. You have the retained earnings, guys. So retained earnings is the second thing that you should show. You have your mark-to-market reserve account, which is the third thing that you should show. Then for mark-to-market reserve account, we are talking about those financial assets that are measured at fair value through OCI. For only second year, we only deal with fair value through OCI. You have revaluation surplus. The revaluation surplus, it's always for land, and in the previous video of the statement of comprehensive income, I explained the revaluation surplus. I hope it does make sense if I explain it in this way, guys. So it's actually share capital, retained earnings, mark-to-market reserve account, revaluation surplus, and total. Does it make sense? So I feel like explaining this one will be very much confusing since you haven't done the prior period errors. So explaining the statement of changes in equity using this format won't be much effective. I want to actually explain it in a way that you have to understand it, and I think you will get it if I explain it in this way. So guys, your statement of changes in equity, let me start by doing and drawing them. A statement of changes in equity, you have to, let's actually illustrate the drawing. You will have discount. It's a mistake, guys. So let me go back. It's a mistake that I actually made. I hope it is fixed. Then okay, let me close these curtains because the sun rays, it's actually, sorry for that, guys, for disturbance, because the sun, it's actually, yeah. So on the statement of changes in equity, guys, I will start by drawing the right one that I feel like you have to know it. Does it make sense? Because that one, it has prior period errors which you haven't done so far. You will do them in second semester, unless if they change the content. But most of the time, prior period errors and events after reporting periods are done in second semester. So that's what you will have in your in your statement of changes in equity. So you will have ordinary share capital. So ordinary share capital, they can call it class A share capital and other words. Then you also have preference share capital. Preference share capital, you can call them class B share capital. You have retained earnings. After share capital, it should be followed by retained earnings. So sometimes you might only have ordinary share capital without having preference share capital, which is more understandable. So you don't have to actually write the column of preference share capital if you don't have the preference shares, or if you don't have the class B shares. The retained earnings column, you will have the what? The revaluation of land, PPE, and you will have the mark to market reserve account. You will write it in full. It's mark to market reserve account. Does it make sense, guys? So that's actually how it will go. Oh, why should I actually do this such thing, guys? Yes. So the first thing, you got your what? You got your ordinary share capital, preference share capital, retained earning, revaluations, mark to market reserve accounts, and let me use this color, the green one. So the first thing that you should have, it's actually your balance at beginning. So balance at the beginning, you have a balance at the beginning for ordinary share capital, for preference share capital, for retained earnings, for revaluation of PPE or revaluation of land, and mark to market reserve account. All of them, they have the what? The balances. Does it make sense, guys? So there's no a column that will not have balance at the beginning, unless if that thing has started this year. But the balance at the beginning, if it started this year, then it will be 0 in that case. Does it make sense? Like we started revaluing land this year, that means balance at the beginning for revaluation surplus will be 0, and we will have it under the movement. Does it make sense, guys? So that's actually the first thing that you should have. Then the second thing that you should have, it's actually issue of shares. Why is it not showing? Issue of shares. So issue of shares, we can either issue ordinary shares or we can issue preference shares. We can never issue retained earnings. We can never issue revaluation. We can never issue mark to market reserve. Does it make sense? It's always issuing of shares. It applies to ordinary share capital and preference share capital, and it has a positive balance. Positive balance, it's always positive balance, because when we issue, we are adding. We can call it additional shares issued, so you are adding them. So these ones are actually 0 balances. You don't actually have issue under the retained earnings and revaluation, as well as mark to market. Then another one you can have this one. You will have what? You will have profit. Oh yeah, profit after tax for the year. So it's profit after tax. So if you remember clearly, in our statement of comprehensive income, you will draw a statement of comprehensive income, and you will have a line section for profit after tax before you go to other comprehensive income. So you will have profit after tax, and that profit after tax, you should actually add it here. Does it make sense? Under the retained earnings column. So it doesn't actually apply to ordinary shares, it doesn't apply to preference, it doesn't apply to revaluation, as well as mark to market. Does it make sense, guys? So profit after tax will be added here. But what if it's a loss? Then you will actually subtract it as loss. But most of the time, it's unlikely for it to be loss. It's always profit after tax, so you will add it. Does it make sense, guys? I hope it does make sense if I explain it in that way. Then after that, guys, you will go to your third item. Your third item will be OCI, other comprehensive incomes. Other comprehensive income, it doesn't apply to ordinary share capital, it doesn't apply to preference share capital, it doesn't apply to retained earnings, it doesn't, it applies to what? To the revaluation of land and to the OCI, to the mark to market reserve account. So it's, if you have a gain on revaluation, you would add that OCI here, and if you have a loss, you would subtract it. Gain on, profit on fair value adjustment on shares that are measured at fair value through OCI, you would add that here. If you have loss on fair value adjustments on shares that are measured at OCI, you would subtract it. Does it make sense, guys? So that's actually how it works. Does it make sense, good people? Then you would go to what? Another one, they normally say total comprehensive income. Remember, total comprehensive income is the combination of the two, where you will have total comprehensive income, and in the line item section of what? Of retained earnings, you can put profit or loss or after tax, and revaluation, you can put gain or loss on the revaluation of land, mark to market gain or loss on the profit or unfair value adjustments on shares that are measured at OCI or something like that. So I prefer you guys that you should actually do what? You should write profit after tax or loss for the year and OCI, separate them. Does it make sense? It makes much sense if you do it that way. You won't be penalized. So another one that you should follow, guys, when we go on, we have this thing called what? We have this thing called transfer of reserves. So transfer of reserves, guys, it doesn't apply to share capital, all of them. It only applies to what? To mark to market reserve accounts and to revaluation of land. So what is transfer of land or of reserves where? It works when, remember, land and shares that are held at OCI, sometimes you may sell them. When you sell them, they are OCI, it will be transferred to retained earnings. Land that you were measuring at revaluation, its revaluation surplus when you sell that land will go to what? To retained earnings. So the land revaluation surplus will be added to the retained earnings if you are selling it. To the shares that are measured at fair value through OCI, when you're selling them, their OCI, profit on fair value adjustment through OCI, and will be actually added to the what? To the retained earnings. So that's why it's called transfer of reserves. You are transferring, because you are selling it, you are transferring it to the what? To the retained earnings, as well as when you are selling the land, if you remember clearly. I hope it does make sense if I explained it in that way. Then we go to, why should I choose that? We go to the what? We go to the dividend declared. So the dividend declared, they don't affect share capital, they don't affect preference share capital as well. They affect the retained earnings. So you should subtract the dividends declared in the retained earnings, because you are reducing an equity. You are paying, when you pay, you remove it from equity. Does it make sense? So it's a reduce in equity. You would put it in the retained earnings, and it doesn't apply to the revaluation, and it doesn't apply to the mark to market reserve. So it applies to the retained earnings. Does it make sense, guys? I hope it does make sense if I explain it in that way. So you are actually declare the dividend. And another issue that you can have, it's called what? It's called capitalization. Capitalization, you subtract it from retained earnings and you add it either in the preference and you add it or in the ordinary share capital. Because remember, the journal for capitalization, you would debit what? You would debit retained earnings, and you would credit capitalization reserve. Then after that, you close off the capitalization reserve, you close it off to what? To share capital. So capitalization, good people, it actually adds to the share capital, and it adds to the what? It adds to the retained, to the preference share capital. The reason why we say they are actually added to the share capital, it's when you declare the dividends, guys, and you don't have money to pay the dividends, you say, instead of paying you dividends, we would actually give you the shares, and those shares you won't pay for them, you will pay them it's more like a consideration for dividends. Does it make sense? So you pay the shareholders dividends by giving them extra shares. Does it make sense, guys? So it would be subtracted from retained earnings because it's treated more like dividend, and dividend it decrease our retained earnings. Same apply here. It will be treated under the retained earnings. You would subtract that capitalization reserve or the capitalization of shares. And since you are actually issuing shares, but you are issuing them for no consideration, that you are receiving no consideration, you would add it in your preference shares because you are issuing. It's more like additional issue of shares. Does it make sense, guys? And that additional issue of shares, you are paying something, which is the dividend. So that's why you subtract from retained earnings and you add to either share capital or preference shares. It depends on what shares are they paying with. So if they pay with Class B shares or the preference shares, then it will be an addition to the preference shares. But if you are paying with the what do you call this one? If you are paying with the Class B shares, it will be an addition to the ordinary shares. Does it make sense, guys? Then you are done with your capitalization. Then you have this thing called share issue costs. So share issue costs are the costs that we incur when issuing the shares. Does it make sense? So like for example, we normally hire an underwriter to issue shares on our behalf. So that underwriter can't just issue shares on our behalf. We have to pay them a commission. So the commission to underwriter would be a share issue cost. It's not an expense, it's a share issue cost. So the share issue cost, it's always subtracted from the share capital. If we have actually issued ordinary shares, then it will be subtracted under ordinary shares. If we have issued preference shares, it will be subtracted under preference shares. So it doesn't actually apply to this one and this one as well as this one. So it only applies to the share capitals because it decreased the value of our share capital. Those share issue costs, you would subtract them here. I like actually repeating things more and more because people understand when you repeat something more and more. So let's actually go to the next one. The next one, it's actually I like the word actually, basically, as well as basically. So I like these words. So the other one that you should focus on, it's repurchase. At average. So repurchase of shares will always work on the share capital, ordinary share capital. You would subtract those shares at the average price. Does it make sense? So let's say we repurchase 50,000 shares. So you will say 50,000 shares times the average share price. So the average share price will be multiplied by the number of shares that are repurchased, and you subtract it there. So it's actually a reduction to your share capital because you are repurchasing them back. You are purchasing them back. You are unissuing them. Then it doesn't apply to preference shares. It doesn't apply to preference shares. Some they could ask themselves, why doesn't it apply to preference shares? I will explain to the next line item. It doesn't apply here. It doesn't apply to retained earnings, to revaluation, as well as the mark-to-market reserve account. Then we actually go to the next line item. The next line item, guys, it will be what you call the redemption. So the redemption, guys, it's not applicable to ordinary shares, but applicable to the what? To the preference shares. So what is redemption? Redemption is the repurchasing of preference shares. Does it make sense? So you are repurchasing preference shares. So it's the same application for repurchase, but for preference shares. So they can say the preference shares are redeemed at premium. That means you would actually take the par plus that premium rate. So if the par is 200,000, so it will be, and they say premium of 8% plus 8% of 200. Does it make sense? So that's actually the redemption. You will subtract the redemption value here and if they are redeemed at par, you would actually also subtract the redemption there at that amount. Does it make sense? So it's not applicable to the retained earnings, not applicable to the ordinary shares, not applicable to to the revaluation, and as well as the mark to market reserve account. So then the other one that you should know, it's actually I feel like everything that I've mentioned, it's what you should know for now, but there are a lot. So you will have what you call the what? You will have your balance at end. So the balance at the end should always be shown. And the total line item or the total column, it's not important if they don't say anything about it. But if they say it's required, please draw it. But if they say it's not required, you don't have to draw it. Doesn't make sense because you will waste your time. So the total line item will be here, where you will total, write them here. So, but if they don't say anything about it, don't actually try to make things much difficult for you and try to put them there, even if they are not required. Doesn't make sense, guys? So it will be this way. So your statement of changes in equity will be this in this format: statement of changes in equity. So please, before you get into the exam room tomorrow, please make sure you remember this format.